This is Lecture 14, Long-Term Assets and Depreciation 2. Okay, last time we talked about depreciation methods. So today I want to expand on that a little. So let's take a look at a new example. Nate Company has a December 31st year end. On January 1st, 2020, Nate purchased equipment for $2,000. The equipment had a salvage value of $200 and a useful life of 5 years or 6,000 hours of production time. Okay, so first, we're going to calculate depreciation expense on the equipment for 2020 and 2021, assuming it was used for 1,000 hours in 2020 and 800 hours in 2021. Right, this is essentially a review of what we covered last class, so we'll go through it a little more quickly than last time. Okay, so first method we're going to cover is straight line. And under straight line, we calculate the depreciation expense as the cost minus the residual value divided by the years of useful life. So let's put in the numbers from this particular question. And we know that the cost is $2,000 and the residual or salvage value, remember those mean the same thing, so salvage and residual value are the same, $200, and then there's a 5-year life. So that's $360 per year. Now we have a test coming up, and I have to admit that when I write tests, even writing tests for online, it gets really boring writing the same question over and over again. So often what I'll try to do is ask different questions that still require you to know the same things. So the obvious question here is, what is the depreciation expense for year 1 or year 2 or year 5, right? But how about instead if I said, what is the accumulated depreciation at December 31st, 2021? And let me get that done there. So December 31st, 2021, that would be after 2 years of use. So that means that we're using it for 2020 and 2021. So how would I calculate the accumulated depreciation? Right? Well, I would just add together all the depreciation from the years that have passed already. So from those first 2 years. So I would add the 360 from 2020 and the 360 from 2021 to give me a total of 720. Now, another thing that I could ask is, what is the net book value at December 31st, 2021? Okay. Well, remember, net book value, right, is the same as net value, and it is the cost minus the accumulated depreciation. So in order to calculate the net book value at December 31st, 2021, I'd have to take the cost, which we know is $2,000, and subtract the accumulated depreciation, which we know is $720. So then I would calculate that as $2,000 minus $720, which is $1,280. Okay, so those are just 3 different ways I could ask a question about depreciation, and all of them would require you to know how to calculate the depreciation expense for each individual year. Okay, let's try this again using the unit method or the units of production method. Now, under units of production, remember we calculate depreciation expense per unit. So we do that by taking the same cost minus residual value and dividing by the units in the useful life. And if we put in the information from this particular question, then we know that, for some reason I've got this wrong number in here. We've got 2,000, let me fix it right now. We've got 2,000 hours, we've got $200, and we know that it's going to have a useful life of 6,000 hours. So even if I copy the wrong thing, we can still put in the correct amount. Okay, so knowing that, we know that the depreciation expense is going to be 30 cents an hour. That part, fortunately, is correct. Okay, so let's get the depreciation expense for 2020 and 2021. Now, to get the depreciation expense for the year, we need to take the depreciation expense per unit and multiply by the units used in the year. And in this case, the units are the hours, right? The hours of production time. So in 2020, we know that they had 1,000 hours, right? And we know that it was 800 hours in 2021. So in 2020, 1,000 hours at 30 cents is $300. And in 2021, 800 hours at 30 cents is $240. Okay, so that's the depreciation expense for each individual year. Now, suppose I asked you for the accumulated depreciation at December 31st, 2021. Well, to get that, I'd have to add these two together, right? So I'd take the 300 plus the 240, and that would give me $540. All right, lastly, suppose I asked for the net book value at December 31st, 2021. Well, remember, net book value is cost minus accumulated depreciation. Okay, so we're going to take the cost of $2,000 minus the accumulated depreciation of $540, and that is going to give us a net book value of $1,460. All right, let's try one more time with double declining balance. Now, under this method, we calculate a depreciation rate, and that rate is calculated as 2 over the useful life. Okay, so let's put in our numbers here. We know that the useful life is 5 years, so we're going to have 2 over 5, or 40%. Now, to calculate depreciation expense in 2020, what I'm going to do is take the net value at that time and multiply by my 40% rate. So what's the net value at the start? Well, to start with double declining balance, the starting net value is always cost. And this is a mistake I see a lot of students make, because over here in straight line, we do cost minus residual value. And over here in unit, we do cost minus residual value. And we get so used to that by the time you get down to declining balance, you want to do cost minus residual value. It does not work that way. Okay, with declining balance, we don't even think about the residual value until the end when we're doing our plug. Okay, so we just start with the full cost. That's one of the advantages of double declining balance, because we just use the cost and we don't actually have to know the residual value up front. Okay, so the first year, the starting net value is always cost. So in the first year, our net value of cost is $2,000 times our 40% rate is $800 of depreciation expense. All right, now for 2021, what's the net value going to be? Well, it's going to be the cost of $2,000 minus the $800 of depreciation we've already taken. So that will be $2,000 minus $800 times our 40% rate to give us $480. Now, suppose I asked for accumulated depreciation at December 31st, 2021. Well, to get that, I'm just going to add the two numbers together. So I'm going to add the $800 plus the $480 from the second year, and that gets me $1,280. If I asked for the net book value at December 31st, 2021, that's the cost minus the accumulated depreciation. So I take the cost of $2,000 minus the accumulated depreciation of $1,280. and that's going to give me 720. Notice if I were going on to year 3, I would need the 720 because that would be my net value. That would be my number here for the next year's calculation, right? So with declining balance, that's something you're going to need to probably calculate anyway. All right, so that's what we covered last class. Now let's get on to our new material for today, which is in part B. The equipment was used for 500 hours from January 1st, 2022 through June 30th, 2022. On July 1st, 2022, Nate sold the equipment for $950 cash. So we're going to write all required journal entries to record this transaction. Okay, I've italicized the word all journal entries. So what do you think that means? Well, you probably guessed it means that there's more than one journal entry. So it's not just a single journal entry to sell the equipment, there are two things. Okay, so we are selling the equipment, but we're not selling it till July 1st. What happened between the start of the year at January 1st and July 1st? Well, the answer is the equipment was used, right? It says right there in the question, the equipment was used between January 1st and June 30th. Now, if the equipment is used means depreciation, right? Used in general means expense, and for a long-term asset, that would be depreciation expense. So even before we sell the equipment, we have to update the depreciation expense to the day of sale. So that is always required. So before we can actually do the journal entry to sell the equipment, we need another journal entry to update the depreciation expense. And that's what I'm looking for in this question when I say all the journal entries. I mean the one to update depreciation and then the one for selling the equipment. Okay, so we're going to do this again under all three methods. So let's start with straight line. Now, under straight line, we already calculated back here, we calculated the depreciation expense is $360 per year. Okay, so that means our depreciation expense for 2022 is going to be $360. But wait a minute, $360, that is per year. That's for a whole 12 months. Did we use the equipment for 12 months in 2022? Well, the answer is no, because we only used it from January 1st through June 30th. That is for half the year, for 6 months. So what we have to do is we have to cut down that $360. That's for a whole year, but we've only used the equipment for half the year, or 6/12 of the year. So that means the depreciation expense for that half year is $180, right? So we have to cut it down because we did not use the equipment for a whole year, and 360 represents an entire year. Okay, so now that we know how much our depreciation expense is, we can do our journal entry, which is to debit depreciation expense, and the credit goes to accumulated depreciation for $180. Okay. All right, so now that we have updated the depreciation, we can actually do the journal entry to record the sale. Okay, so let's think about it. What's going to be in the journal entry to record the sale of equipment? Well, the obvious thing is $950 cash. So we know that we're going to have a debit to cash for the company of $950. Okay, what else? Well, next most obvious thing, they're selling the equipment. So the equipment has to go away, right? So I'm going to leave a couple of empty spaces, and then I'm going to credit the equipment. Now I'm crediting the equipment for $2,000 because that is the equipment's cost, right? That's its original cost that it was way back when we purchased it. Remember, historical cost, right? We keep the assets at their original cost and we stay there, right? Okay. All right, now, this reminds me of a silly story from when I was in university. Um, I had a circle of friends, most people do, and I was not the exciting one in my circle of friends. I mean, heck, I was studying accounting, right? There was one girl, and she was the one with the exciting life. She was the one we always gossiped about because, what was she doing next and what was going on? And of course, the big thing is that she had a very exciting love life, right? She was with a new guy every week. So every week we'd turn around and there'd be a new guy on her arm. And, it would just be very interesting to talk about her love life because in comparison, ours were all very dull. She was with a guy for a whole month. That was a very serious relationship for her. So, very exciting. Now, I remember there was one day I borrowed some notes or something like that, and I was going over to her house to return them. And as I approached, I saw her latest, I guess, ex-boyfriend standing on the lawn wearing nothing but his underwear. And she was standing upstairs at the second story window and she was throwing his sneakers at him. So she threw like one shoe at him and he kind of ducked and then scrambled to go pick it up. And then she threw the other shoe at him. And, then she was so mad. I don't know what he did, but whatever he did, she was so mad. She then threw his jeans out the window at him and then his t-shirt. And then she threw his backpack out the window. And of course, he's running around the lawn scrambling to pick up all his stuff, right? So obviously that made a big visual impression on me, right? Of my friend, standing out. Whatever this guy did, she was so mad that she kicked him out and she had to kick out all the stuff that belonged to him too. So he went out the house and she threw everything he owned out the window and it was all going. Now, strangely, in accounting, we do the same thing, except instead of a boyfriend, right, it's the equipment that we're throwing out. So the equipment is in its underwear, running around on the lawn, right, and being tossed out. And we as accountants are really mad at that equipment. We want it gone. So we're going to get rid of anything that belongs to the equipment. Okay, now the equipment doesn't really have clothing. What belongs to the equipment? Well, the answer is accumulated depreciation belongs to the equipment. In fact, it's the contra account to the equipment, right? They always go everywhere together. When we throw the equipment out, not only are we looking to get rid of the accumulated depreciation that belongs to it, the accumulated depreciation says, hey, you threw out my partner, wait for me! And it jumps out the window after the equipment. So when we get rid of an asset that's depreciated, like equipment or anything else, when we get rid of that asset, we also have to get rid of any account associated with it, which in this case is the accumulated depreciation. So as we remove the equipment, we're also going to remove the accumulated depreciation from the records. Okay, now here's the tricky part. To get rid of the accumulated depreciation, will I debit or will I credit? Who knows? All right, well, let's find out. The answer is that to get rid of the accumulated depreciation, we have to debit. Now, you may have figured that out already because here in this entry, we credited accumulated depreciation, and that was an increase. So clearly, to decrease, we'd have to do the opposite. We'd have to debit. Okay, but what if you didn't have that entry in front of you? How would you remember that to get rid of the accumulated depreciation, we have to debit? Well, the trick is you have to remember that the accumulated depreciation is a contra account. It is opposite to the equipment. We are crediting to get rid of the equipment, so the opposite is to debit accumulated depreciation. right? So that's how we know we're going to debit accumulated depreciation. So we know that that's going to go in there. So we're getting rid of the equipment, and then we're getting rid of its associated accumulated depreciation, and that is opposite from the equipment because it's the contra account. Now, of course, the next question is, well, how much accumulated depreciation is there? All right, well, let's go back here in the first part. We determined that the accumulated depreciation at December 31st, 2021 was $720. But that was at December 31st. Have we had depreciation since then? Why, yes, we have, because remember this? We had $180 of depreciation expense in 2022. So the total accumulated depreciation at this time is going to be the $720 we had at the end of last year, plus the $180 that we just recorded now. So in total, the accumulated depreciation is going to have $900 in it. So we are going to debit the accumulated depreciation for $900. All right, we're almost done. You can kind of tell because, hey, we only have one empty line here in our journal entry. So what's it going to be? All right, well, this is a situation where we're selling off a partially used asset, and that is not part of the regular course of business. Remember a little while ago, we talked about this. What do we do with transactions that are not part of the normal set, right? Well, the answer is that we record them as gains and losses. So the last thing here that we're going to use is going to be either a gain or a loss. Okay, so to figure out which one it's going to be, we first need to figure out the plug. What number do we need? All right, well, in order to finish this entry, it's pretty clear we're going to need a debit to make it balance. And that debit is going to have to be 150, right? That's our plug. It's the number that fits the hole and makes the journal entry work. Now, because that plug is a debit, it's going to be a loss. So we're going to have a loss on sale, or just plain loss is fine too for this class. Okay, so how do I know? Because a debit is like expenses, right? So we have that on the income statement where the debit is going to be in the same direction as expenses. It's going to reduce net income. That's why it is a loss. All right, let's try this all over again with the unit method. Okay, so for the unit method, we have to start all the way back at the beginning. Same thing. We've used the equipment in 2022, only for half the year though. So we're going to have to calculate our 2022 depreciation expense. Now, under unit, we already determined that the depreciation expense was 30 cents per hour. Okay, so that 30 cents per hour, we're going to have to multiply that by the number of hours that we actually used. Well, in the question, we're told that the equipment was used for 500 hours. Okay, so we're going to have 500 hours times 30 cents. All right, now, in the previous example with straight line, we multiplied the 360 by 6 over 12. Do we have to do that here? All right, good question. So why did we multiply by 6 over 12 here? Well, the answer is 360 represented an entire year of depreciation. And we didn't use it for an entire year, so we had to cut it down, right? We had to reduce the amount because this represented 12 months and we only used it for 6. Okay, here, 500 hours. Does that represent an entire year? No, it doesn't. If we look at the question, the equipment was used for 500 hours from January 1st through June 30th. So the 500 hours is already representing only the 6 months that were used, right? There's no year here. It's only the 6 months we actually used it. That's one advantage of units. Since we're tracking the actual usage, it's already automatically adjusted for the fact that it wasn't an entire year. Okay, so we do not need to multiply by 6 over 12. The fact that it's 6 over 12 is already incorporated in the 500. So the 2022 depreciation expense is just the 500 times 30 cents, or $150. Okay, now that we have that, we can record our depreciation in a journal entry where we debit the depreciation expense and credit the accumulated depreciation, $150. All right, now we get to do the journal entry to sell the equipment. Okay, first obvious thing, we're receiving cash. So we're going to debit our cash for the $950 we received. Okay, next obvious thing, we are going to be selling the equipment. So we're going to have to credit the equipment for its original cost of $2,000. Okay, now when we get rid of the equipment, we're going to have to get rid of anything associated with it. What's associated with the equipment? The accumulated depreciation, right? It's contra account. Now, to get rid of the accumulated depreciation, are we going to debit or are we going to credit? Well, we're going to have to debit because the equipment is an asset and the accumulated depreciation is its contra account. So it would be the opposite direction to get rid of it. So that means we're going to debit accumulated depreciation. All right, now how much is accumulated depreciation? Well, back here in the first part of the question, we calculated that the accumulated depreciation at December 31st, 2021 was $540. Since that time, we've had another $150 of depreciation expense in 2022. So the total accumulated depreciation at the time of the sale is going to be the $540 through 2021 plus the $150 from 2022 to give us $690. So the accumulated depreciation is going to be $690. All right, lastly, we need to finish the entry with a plug. Now it's pretty clear the plug has to be on the debit side. We're going to need a plug of $360. Now it's on the debit side, so is that going to be a gain or a loss? Well, on the debit side, that's the same direction as expenses, so it's going to be a loss. So the full entry is going to debit for loss or loss on sale. Okay, one more, double declining balance. All right, under double declining balance, we calculate the depreciation expense as the net value multiplied by the depreciation rate. So back in part A, when we did this before, we already calculated the net value, right, at the beginning of the third year. So it's going to be 720 is our net value, and then we'll multiply by our 40% rate. So our depreciation expense is going to be the 720 times 40%. Okay, now back here with straight line, we multiplied by 6 over 12 because the 360 represented an entire year's worth of depreciation. With the unit, we did not multiply by 6 over 12 because the 500 already represented only 6 months, so it was already incorporated there. Do I need to multiply by 6 over 12 here? All right, well, here's the key. Is this a full year of depreciation? Well, let's think about it. Suppose I wasn't selling the equipment and I just used it for the whole year 2022. Would this be my depreciation expense for the entire 2022? Yes, it would, right? If I hadn't sold the equipment, this would be my answer for year 3. So this is a full year of depreciation. That means we do need to multiply by 6/12, by the portion of the year. So let's do that. Multiply by 6/12 to give us 144. Okay. The quick and dirty answer is the only time we don't multiply by the fraction for the year is with unit. Unit is the only method that already takes into account the fact that it's a shorter portion of the year. All of the other methods calculate an annual depreciation, so we do have to multiply by the portion of the year, which in this case is 6/12. Okay, so now that we know it's $144 of depreciation expense for 2022, we're going to record that in a journal entry where we debit depreciation expense and credit accumulated depreciation. All right, now we can get to the journal entry to sell the equipment. So one last time, let's go through. Start with the easy part first. We're selling equipment for cash. So we know we're going to have to debit cash for $950. We're selling equipment. So that means we're going to have to credit equipment for its original cost of $2,000. Now, when we get rid of the equipment, we get rid of anything associated with it, including its contra account of accumulated depreciation. Because it's a contra account, to get rid of it, we're going to have to debit accumulated depreciation. Now, how much is the accumulated depreciation? Well, from the previous part, right, we determined that the accumulated depreciation was $1,280 at the end of 2021. And we know that they've depreciated $144 for 2022. So the accumulated depreciation is going to be the $1,280 from the end of 2021 plus the $144 from 2022 to give us $1,424. Okay, so that is our accumulated depreciation. Now we're almost done here. Okay. The last thing we need to do is fill in the final number. We're going to need a plug. This time the plug is going to have to be on the credit side, because if you look at it here, right, this is clearly more than $2,000. All right, so how much do we need? Well, we need a plug of $374 to make it work. All right, now we are going to have something in here, and it's going to be either a debit or a credit. Which one, a gain or a loss? Well, we know it's a credit, right? And on the income statement, credit is the same direction as revenues. And so that means we're going to have a gain. So the total entry here is going to show a gain on sale, or just plain gain, of $374. Okay, so just to review, if the plug is a debit, it's a loss, and if the plug is a credit, it is a gain. Okay. All right, now let's take a look at these 3 situations here. The only thing that was different between this situation and this one, whoops, and this one and this one, the only thing that's different between the 3 is the depreciation method, meaning the amount of depreciation, right? In all 3 examples, the cash was the same and the cost of the equipment was the same. What was different was the amount of accumulated depreciation. Now, notice in the first example with straight line, we had a loss. In the second example with unit, right, we had an even bigger loss. But in the example with double declining balance, we had a gain. The only thing that is deciding whether it's a gain or a loss is the amount of accumulated depreciation. So if we use a method like declining balance where we take a lot of depreciation, then the accumulated depreciation is very high and we're more likely to have a gain. But if we use a method where the depreciation expense is lower, right, then we'll have a low accumulated depreciation and we're more likely to have a loss. Okay. Now, in a few weeks, we're going to be talking about cash flow statements. And at that time, I'm going to bring up this example again. I'm going to say, hey, do you remember that example with Nate Company where we sold the equipment and we had different amounts of gain and loss? All right, I'm going to bring that up in a few weeks, and you're totally going to remember it. I know you are. But my point at that time will be that the amount of gain or loss is dependent on the amount of accumulated depreciation that was taken. Right? So it's entirely dependent on the depreciation as to whether we have a gain or a loss and how much. Okay, so that's what we're going to be covering about depreciation. Now, I do have one other topic that I would like to speak about today, and that is the topic of warranties. Now, we are used to buying a product and then it is offered with a warranty. Now, for the consumer, a warranty is a good thing because you buy something and the warranty says if it is broken, right, or if it breaks down later, then we will repair it or possibly even replace it. Okay. So let's say, for example, that I go purchase a new tablet at Best Buy. Right? And I am so excited, right? I am walking out in the parking lot. I'm so excited. I'm opening the box, right? And I'm getting out my new tablet before I'm even back at my car. All right. And of course, I try to turn it on. It doesn't work. What do? I turn right around and go back into the store and I say, hey, this tablet you sold me is defective. It doesn't work. It can't turn on. And they look at me and they say, you stupid idiot, you have to charge it first. Okay, so that's me being stupid, but the point is that I felt that something was wrong and I was able to come back and demand that they fix it for me. That's what a warranty does. So for the consumer, the warranty is a good thing, right? It's a promise, it's a guarantee that it'll help out if there's a problem. But what about the company? For the company, the warranty is a promise, an obligation. And of course, in accounting, obligations are liabilities. If a company offers warranties on their products, they are offering this promise, this liability that in the future, if something breaks down, we are going to fix it. Right? So for us, it feels like warranties are good things, but for a company that offers the warranty, whether that's the store or the manufacturer, the warranty is a liability. Okay, so a warranty is a promise from a company to a customer to repair or replace a product under certain circumstances. So for example, the product's defective, the product breaks down. Okay. The warranty is a liability for the company that's offering the warranty. Now, when is that liability created? Well, the answer is that the liability is created at the time of sale. I had just purchased that tablet and immediately I've said something's wrong and I'm able to go back in right away and get it replaced. Okay, so the warranty liability is immediate. It's at the time of sale. And also at that time, we're going to recognize an expense, a warranty expense. So we have a warranty liability and an expense, and they're both recognized at the time of the product sale. Okay, so let's do an example. On May 31st, Start Electronics Company sold a tablet that cost $350 for $500 cash. The selling price included a 3-year warranty. Based on past history, Start estimated that the repair costs they would have to pay under the warranty were $60. Okay, and it turns out on November 15th, they made repairs under warranty of $45. Okay, so we're going to give all of their journal entries to record the transactions on these dates. So let's start out with May 31st. On May 31st, they sold the tablet for $500 cash, right? Always get the easy part of your journal entries down first. So we sold the tablet, and that means the company received cash. Now, we sold a product to a customer. So that means we did something for the customer. So the credit here is going to be sales revenue. But we sold a physical good. The tablet is what we would call starts inventory, right? So this is what they're selling to customers. So we're going to have to record the fact that they sold inventory and incurred that cost. So we're going to have a second entry where we debit cost of goods sold and credit inventory. All right, so I know this was like a whole 2 chapters ago, but we talked about this, right? When we have products for sale, there are 2 journal entries to sell them, right? First, the one that records the revenue, and secondly, the one that records the cost of goods sold. Now, here's the fun part. There is a third entry that has to take place. We are going to record the warranty liability and the warranty expense. All right, which one's going to be my debit, the liability or the expense? Well, expenses are debits, right? And then the liability, we're increasing the liability, that's going to be a credit. So we're going to have a debit to warranty expense and a credit to warranty liability. And that will be for the $60 because that's the amount that we estimated we'd have to pay under the warranty. Okay, so the key thing is that all of these entries happen on the day of sale, right? The day that we sold this particular product. Now, next on November 15th, Start made warranty repairs of $45. Okay, when we make repairs, we are meeting our promise, meeting our obligation. So what's going to happen to this liability when we make repairs? Well, the liability should decrease, right? Because now we are meeting our promise. So we're going to have a decrease or a debit to warranty liability. The credit goes to however they paid for the warranty, for the repairs. So if we paid for the repairs in cash, so for example, if you took it to a repair shop and we just paid you the money for that, right, then the credit's going to be cash. If we still have yet to pay for it, then it's going to be accounts payable. And it could be any number of other things, depending on what's involved. Right? So if we give you a brand new product, it could be a credit to inventory. If we use some parts, right, there might be supplies or parts inventory. It's however we paid for the repair, right? So that's going to be the credit. Okay. Now notice the warranty liability was set up for $60, but we only used $45 for repairs. What about the extra $15? What happens to that? All right, well, I have 2 answers for that. First answer is it's a 3-year warranty. We still have a long time to go, another 2.5 years. So there may be more repairs on this particular product. But let's say there aren't. Right? Why is there a difference? And is that a problem? Okay. Well, there's a difference because this warranty amount here, this $60 in advance, was a guess. It was an estimate, right? We don't actually know in advance how much we're going to have to pay for warranty repairs. But we estimated that this would be $60 because of our past history. We've been selling these products for a while. Okay. Now, this $60, this estimate is an average. Does that mean that every single tablet that we sell is going to need exactly $60 of repairs? No, of course not. Hopefully, the vast majority of products we sell will never need a repair and will never have to do anything for their warranties, right? That's the plan. But there will probably be some items that need repairs, right? That's just the way manufacturing goes, the way life goes. There's going to be some issue with something. So we've averaged $60, but some products are not going to need any money at all. They're going to need zero. Other products we may have to replace completely, right? Or may need multiple repairs. So even though this particular tablet only needed $45, that presumably the other $15 would apply to a different item that was sold to customers, right? There's just one warranty liability account for every single product we sell. So if one item is over or under, presumably the difference applies to a different product that needed more or less in repairs than this one. Okay? So it doesn't matter that they're different because this is just one item in a whole bunch that are going into the warranty liability account. So since this is under, presumably it'll balance out with another product that is over. Okay, let's try that again with a different example for warranties. Okay, a company had a balance in their warranty liability account of $1,200 on January 1st. During the year, the company had sales of products with warranties of $100. Historically, warranty costs have been 2% of sales price. During the year, the company made repairs under warranty costing $1,400 cash. So what is the balance in the warranty liability account at December 31st? And what is the warranty expense for the year? Okay, before we get to the actual questions, since we're still just learning, let's just do the same thing we did in the previous question, which is go through the journal entries that are required. Okay, so first we know that during the year, the company had sales of products with warranties of $1,000. Okay, so we know that there's going to be some entry to record the sales revenue and an entry to record the inventory and cost of goods sold. Those are going to be there, but we don't have enough information to fill those out right now. What we do have enough information for, what we do know, is that there's going to be a journal entry to record the warranties at the time of sale. Okay, so at the time of sale, we're going to have to record warranty expense, and we're going to have to record a warranty liability. Now, in the previous question, I just told you, I said, oh, they estimate the costs are $60. Most companies don't actually do it that way in the real world, right? They do it differently. So for example, let's take Apple. Let's say you wanted to buy an iPhone. Well, right now, if you want to buy an iPhone, you can buy an iPhone 8, right? You can buy an iPhone X, you can buy an iPhone SE, you can buy an iPhone 11, all kinds of different versions of it, right? Okay. Now, let's say you said, all right, I want iPhone 11. But even then, well, you have different amounts of memory that you can have, right? You can have different other capabilities. There are 4 or 5 different versions of the iPhone 11 that you can purchase. All right, so every single one of these products comes at a different price. And therefore, each one of them is going to have a separate calculation for their warranty estimate. Now, that's kind of painful, right? Every single time you have a slight variation in your product and sell it for a different amount of money, have a different spec on it, you're going to have a different warranty calculation. So how do we make this easier, especially for companies that sell hundreds of different products? Well, the answer is we calculate warranty as a percentage of selling price, right? This is typically what big companies do. So a company like Apple, for example, will calculate their warranty expense as a percentage of the selling price. So If I have an iPhone and it has more memory with it, well, then it's going to be more expensive, and therefore my percentage estimate of warranty cost is going to be more as well. So it's just a convenient way to do it, and this is what you'll see most real companies doing. All right, so in this example, the warranty costs are 2% of the selling price, and we know that the sales of products were $100,000. So that means that our warranty cost is going to be 2% of $100,000, or $2,000. All right, now, the other thing that happened during the year is that the company made repairs under warranty, and they cost $1,400 cash. All right, so what happened when the company made repairs? Well, when we make repairs, we are meeting our warranty promise. We're meeting the obligation. So that means we're actually decreasing the warranty liability, right? Okay, so that means we're going to have to debit the warranty liability for $1,400, right? The cost of the repairs. Now, the credit is how we paid for those repairs. Now, we paid for the repairs with cash. So the credit is going to be $1,400 of cash. All right, so these are the journal entries that take place. Now that we've done that, let's take a look at the warranty liability account. So let's pretend that we are going to draw the warranty liability T account. All right, so there's a title, and it looks like I don't have enough space, so let's put it on the next page. Okay, when we're looking at a T account, the first thing we want to do is put in the opening balance. And the question tells us the company had a balance in their warranty liability account of $1,200 on January 1st. So I know that my beginning amount is going to be $1,200. And I know that's a credit because this is a liability, right? Liabilities are credits. So this is the side of increase for the liability. All right, now what happened during the year? Well, during the year, we debited the warranty liability for $1,400 when we made repairs. Right? And the other thing that happened is we credited the warranty liability for $2,000 when we sold products, right, and recorded more expense. All right, so now we can add everything up to determine what our ending amount is. So if we add up the entire T account, if we take $1,200 minus $1,400 plus $2,000, that's going to give us an ending balance in the warranty liability of $1,800. Okay. So to summarize, for the warranty liability, it can go up and it can go down. It goes up when we sell products and record more warranty expense, right? We see that right here. When we sell products, we record more expense. That increases the warranty liability. It goes down when we make repairs under warranty. And that's what we saw here with the $1,400. Okay? So the beginning amount plus the increase due to selling more products minus the decrease due to making repairs is $1,800. Okay, so to answer the question, the balance in the warranty liability account at December 31st is $1,800. All right, next question. What is the warranty expense for the year? Well, the warranty expense, we already recorded that. That's the $2,000 that we put right here. Okay, so again, you can see how I can ask a question differently. Right? So I can ask a question by saying, hey, what are the journal entries? Or I can say, hey, what's the balance in the account? Right? All of this, even though you didn't have to technically write the journal entries for this, you did still have to know what's the impact of selling products, what's the impact of making repairs, and then use that to calculate the total. Okay? So all of those are different ways I could ask questions about warranties. All right, so that's everything for today. Now we have homework, and because of the upcoming tests, this homework will be due on Thursday. So for Thursday, I'd like you to look at Chapter 6, questions 5 and 6. That deals with selling assets and depreciation. And then Chapter 7, that's where warranties are covered. So question 4 is on warranties. And then next time we will talk more, finish some stuff up from Chapter 6, talk more about other things to do with long-term assets. So until then, stay healthy.